Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is December 26, 2024, and we're going to talk about fixed charge coverage ratio in conjunction with the top performing sectors. It is an interesting move in the market. We've seen a major recovery after hitting record highs and pulling back anywhere from 5 to 10% in some of the indexes to see price recover and get back into that same area. It's the end of the year. This is when, as the professor would say, we are performance chasing. This is when we're trying to keep the prices high to the last few days of the year, if not the last single day and hours, to lock in those gains for the year before we oftentimes see a correction. Now, there's also people that speculate on pullbacks or rallies in the first days or weeks of January, which can be dispelled. But I want to talk about it from the idea that regardless of what happens in the market in January, whether it's predictive or not, if we see hedging, if we see defensive plays, if we see uncertainty, then we want to bet on the strongest of the strong. And so today in the TheoTrade main room, I discussed the idea of fixed charge coverage ratio. Now that's a lot of words to simply say what we're looking at is, do these companies make enough revenue to cover all their day-to-day fixed costs that they're going to incur every day, every month, every year as part of their rents and leases, etc. So if we can find that those companies have a multiple 3 times or higher, that means we know that their fixed costs or fixed expenses are a third of what their earnings are. And I've also put in here a quick ratio, meaning that if you look at their assets versus their liabilities, with their assets pulling out inventory, do they have enough to cover their costs for the year? So if I find the best of the best, the most stable, the ones with the best income and the most assets versus the liabilities, this should set us up for some stable stocks. Maybe not the fastest growing stocks, but the ones that should be more stable going into this next year and even into the end of the year when we have corrections or repositioning going into the end of the year. And today, and coincidentally this last 3 months, the couple of top sectors have been technology and financials. Financials had a really good day today and a really good quarter along with technology, and surprisingly consumer staples are starting to rise again, and that would be also an indication that we want to be looking at those defensive plays. So as I'm looking at this, you'll find that some of these stocks that meet the conditions are certainly information technology, and you'll see as I move here lower, we have consumer discretionary, healthcare, communication services, more energy stocks, and we can scroll down and find there's some financials and more energy and more energy and more energy. And so it's interesting to me that the top performing sectors are not necessarily the ones that are the safest, but we have a little mix of about all of it, but a lot in the energy sector, consumer staples, and a lot in information technology just because of the amount of revenue that they have. So these are the kind of stocks that I would be looking for. I'd be looking for positions in NVIDIA and Broadcom and AMD. I'd be looking for things in Occidental and CVS and Google. And we've talked about Google, and we talked about Palantir, which is down the list a little bit further. And we've even looked at Microsoft today. So as we're watching this, I want to look at the charts and say, okay, are we set up for the right timing in stocks like this? And to do this, I'm going to use different indicators than what I used earlier today, and I'm going to use a 40, 50, 200 crossover. Now, what do I mean by that? As long as the price is over the 200 and the 40 is over the 50, we're going to assume that this is still in the trend in the right direction, because these are all looking for bullish opportunities. I'm also going to be paying attention to their implied volatility percentile, because I think that's important to determine what kind of strategies we may want to look at. So if we look at Amazon, the trend has been up. The 40 has been over the 50, and the price has been over the 200 all the way back since October 2nd, and the price would have gone from 180 to 228. Generally speaking, that fixed charge coverage does not change in the short term. It's a big quarterly report based off of earnings, and therefore we expect this to be in this type of pattern for longer periods of time. So this has been bullish all the way since October and still is bullish, and we might be looking for a breakout through the high. You take a stock like Occidental, and it's been very bearish because the entire energy sector is bearish. But if we are looking at this as a discounted way to get into energy, this is one of the top stocks as far as the ability to meet their debt and their liability obligations. If that's the case, they may be one of the best ones for a bounce and recovery if and when we see energy stop falling. the 40 and 50 is still crossed down. Theoretically, we need to wait all the way till we get to 57, but because this is a safety play, if we can get paid enough premium on the short put, or if we can buy into this and collect the dividend on Oxy, they don't have to move higher. They just have to not go lower. So I would like to see the 40 and 50 cross up and then see if they stop going down, and if they continue to get paid their dividend, which is only about 2% roughly, but we're going to see if this stabilizes down here near these lows. And this is the way it's going to be with all the energy stocks, by the way. As we look at CVS, same kind of story. It would need to get way up here, but it's a discounted stock and a stock that actually has a high probability of stabilizing down here near these lows. So we just wait for price to recover. Google, the alphabet A, as we're looking at that, that is the one that we've said that we liked last Thursday. We talked about it last week, and you can see since last Thursday we've gone up and up and up, and we've climbed about 5%, and we're looking for this to continue. The trend has been up and bullish since back here about 175, and we expect that to continue to move higher. Let me show you Comcast, and then we'll look at another energy stock before we look at Microsoft. Prices down here, again, discounted at key support level. Now, their options are fairly cheap. It's a 26th percentile, so this would be more of an in-out type of spread. This is one that we would target to get back to the 200-day, as it is highly discounted, and yet they have good earnings compared to their fixed costs. Let's go take a look at Microsoft. Microsoft still pushing higher. Nice bounce after the pullback. 40, 50, 200 is all cross positive, so I like Microsoft here, and I don't think we need much of a confirmation at these levels, at least not at 440. We could see this continue to move higher. Options, again, are relatively cheap, so it could just be a buy a call and sell an out of the money call, but it looks pretty promising for Microsoft to continue to move higher. Coca-Cola, holding. High implied volatility. This is one where we could sell a put. We can see that it's not going any lower. They have good earnings compared to their fixed costs. They have good quick ratio, which means they don't even have to sell a can of Coke between now and next year, and they can meet all their debt obligations. So probably one of my favorite ones on this based off the fundamentals. Even though it's not going higher, it's one that's very secure in the fact that they have the ability to ride out an entire year at these levels. Freeport has been one that we've liked a lot in the past, but has been sold off, and it's gone down to my little target off my Bollinger Band move, and is holding here at support as well. Again, super inexpensive as far as their options go. So we've knocked down from 52 all the way to 37, and we've seen about a 30% decline in price. This holding near these lows does give us an opportunity to say this one may be bottoming out. It's not necessarily a dead cat bounce. It's just simply watching for this to stabilize and see if we can get this to move back up and get back into the 40s. But the costs are relatively cheap for a fundamental trade. A high flyer that has that similar strong earnings compared to their debt and liability obligations would be Cisco. Cisco has crossed the 200 back here in August and has continued to climb. We've seen a solid 25% gain in Cisco, and we're near the breakout. So if this breaks through the high, I would call it an ascending triangle, or simply just a continuation of the uptrend, or a 52-week high. And this looks very promising. They have a dividend coming up, so be aware of that. You might see a 40-cent dividend if you're already in the stock. That's in the beginning of next year. But as we're looking at this, this could continue to make higher highs and higher lows, which has been marching higher to the tune of about 5 to 8% each time it's climbed. And so Cisco is probably one of the best high flyers here. But let me show you one that you maybe wouldn't look for that is surprisingly solid here. And that is GM. GM is a stable company according to their earnings versus their fixed charges. They have a good quick ratio. They have the things that we would need for this to work out. As we're watching this, we're seeing the numbers move higher. They don't really need to sell any vehicles. GM can make it an entire year without selling any vehicles. As far as their fixed charges, they have 14 years worth of income on average to cover all their fixed charges. So the fact that we've pulled back and bounced, the fact that we've crossed back through all the lines, the fact that we have not got through the 200-day moving average, GM looks very promising to me as a stable trade to take. In addition to that, they do have higher premiums on their puts so that you could get about 3.5% return for just being willing to buy into GM by selling puts to get there. So we've talked about selling puts to get into stocks before. I'd encourage you to go back and watch those classes as well. Now, what else? As long as we're looking for stability, we're just looking for those that are not going to go lower if we see repositioning. But we've already seen the energy sector has sold off. So price here is not indicative of whether the company's stable or not. It is forward looking. We're looking at earnings and we're looking at their expenses. So as we're looking at all this, this does not tell us, just because prices drop back or prices climb, does not tell us that that's a good company or bad company when it comes to debt coverage. As we're looking at these, the discounted stocks could be the best opportunity. The ones that are the high flyers can still be a good opportunity, but we can't throw out the ones that are maybe down near their lows, like Johnson & Johnson, who's providing a pretty high short premium as well. Just be aware we've got earnings out here. And as well, we can take a look at something like Delta. Delta's pulled back off of its highs, but recovered and closing up. We do have earnings coming up. I like this setup from the view that we've crossed back up. We've pulled back enough that it's discounted it. So the price and the timing might be there, but what we do know is that they have the ability to meet their debt obligations when it comes to the fixed charges. Now, their quick ratio, they don't have because they really don't have inventory, but their overall earnings are very promising for them to continue to move higher. Disney is another one that's pulled back off of its highs and looks to be stabilizing and could be pushing higher as well. Disney's options are very inexpensive according to their implied volatility percentile. It might be an opportunity just to buy the stock or even just buy a long call. Earlier today we talked about Kroger, and Kroger is a great setup, pushing higher, great earnings. Even though they are dependent upon all those items in their stores, they don't need to sell any inventory to make it, and they have a solid fixed charge ratio. So Kroger looks very promising, and I like the bounce today and the close higher. It looks very promising to continue to make the higher highs, higher lows, while on a stable underlying debt structure. Now we're going to finish with two different type of stocks, and that is FedEx and General Mills. FedEx has given us a nice bullish bounce off these lows. It's already reacted and responded to earnings. For some reason, it jumped up, sold off, stabilized, and bounced higher. It's a stock that has a good fixed charge coverage ratio. It is one that we'd expect to continue to move higher. They have a good quick ratio, and they beat earnings. So the fact that we put in that high pulled back, it gives me an easy target that we're going to go retest that high again near 293. And so this is setting us up for a bullish move. And even if it's not super bullish, FedEx should be stable with the way their debt's structured and with the fact that they had better than expected earnings and have continued to grow. General Mills is super discounted at near-term support, despite the price of the stock coming down about 10 to 15%. We're sitting here and we've stabilized near these lows, and it looks again like a stock that could base out here and go back up to 67, if not turn back and go all the way back in the 70s. So I'm liking all of these. These are all areas that I would consider as long as we can get some timing. These are the stocks that are going to be safer because they do not need to sell inventory. They do not need to change how much money they're making to meet their obligation. They theoretically, on average, make enough every year to pay for their debt for anywhere from 3 to 100 times over based off their previous year's earnings. So as long as their earnings are stable, all of these stocks have the potential to be very stable in the next year. That's going to do it for me today. Join me tomorrow as Brandon and I do a revisit of 2024, and we'll talk about some of the top performers and some of the lackluster performers in the markets, as well as what we will do the week after is looking forward into 2025. But join us in the morning for TheoTrade Live. Otherwise, have a fantastic day, and we'll see you again next week.